So today's conversation, Simon.
Feels like the world's on fire at the moment, doesn't it, Brendan?
Another pun on the Fireside Chat. Should I have
Yes.
some sort of nuclear mushroom in the background, do you
Oh,
think?
maybe not so reassuring anyway. But obviously, there's a lot of anxiety out there, I think, at the moment. I mean, today we're going to be talking about that new conflict in the Middle East and what it could mean for Australian property investors, particularly through issues like what's happening with oil prices, inflation, interest rate expectations, market confidence. The purpose today is to cut through some of that noise and maybe help people out so people don't get pulled into panic or paralysis, because when investors are unsure what to do, they do nothing. And that can be the worst thing to be doing.
There are times and places where a little caution might in fact be wise as things start to play out. But
it needs to be a conscious decision, not just a reaction.
All right, so the conflict. What does it actually mean? My immediate thoughts go to the people on the ground who are the innocents. Suddenly that happens to you. Your world shatters, and I feel for everybody who's in that pain. And I'm sorry for that.
There will obviously be some people who've got family friends,
correct,
colleagues over there.
My point around that blends back to, well, who are we? How are we affected by this? From a very pragmatic, and this is really a pragmatic perspective. How does this affect our investing, and how does this affect our hip pocket? How does this affect our daily lives? What impact and flow and impact, and when might that occur? We're already seeing impact on oil, which will have the capacity to raise prices. The country runs on fuel. In the absence of fuel, the country doesn't run. We don't get stock in our supermarkets. We don't get stock in our shops. We tend to stop, and that's a problem. The upshot there is, if fuel prices rise, then everything will rise ultimately. This is going to potentially provide inflationary impact, and therefore RBA may raise interest rates. That's the way it might be heading. And we need to be mindful of that. Other impacts are the cost of coffee is going to go up. So those caffeine addicts are going to feel that a little bit.
It isn't so.
It is. I know. It's going to hit the hip pocket. So you'll feel it in daily living, but then you'll feel it also in your projects. So what do we need to do as investors faced with this potential, Simon?
A conflict like this, particularly in the Middle East, where it's really focused around oil producing countries, and you've got the Strait of Hormuz, which is a major transport channel for, I think it's something like 20% of the world's oil passes through, that's now shut down. So that's flowed through into a big impact on oil markets, oil prices. I don't know if you saw it around you, Brendan, but over the weekend, as all of this started to escalate, we saw big queues at the Bowser, people trying to get in before the petrol prices went up. And now obviously petrol prices are going up.
My wife was one of them.
Well, best to be prepared. It's not quite the toilet paper run from the pandemic, but it has a similar sort of a feel to it. That said, you can only fill up with so much petrol at any point in time. So we are going to see, I think, some inflationary pressure in the short term, at least, from oil prices going up. As you say, Brendan, they're kind of an input to everything. Yeah. So if the price of fuel goes up, that can certainly have a flow-on impact into other prices. Does that mean that interest rates automatically go up, though? Do rates have to go up immediately? I don't think that's necessarily the case in my opinion, but it creates uncertainty, as you say.
See, we don't know whether this is a spike or a long-term effect. If this is a spike, again, companies can broadly absorb a hit on costs for a very short period. We'll suck it up. We're not going to affect our sales by putting price up if it's a short-term spike, which we can comfortably absorb. As with the RBA, we're not going to put interest rates up if there's a spike that we can comfortably absorb. It's not going to have a significant or long-term or ongoing impact on prices. But the longer this does go on, the more impact we will feel, and then the more impetus there is to be to need to financially negate and manage. So there's a suck it and see period. Now, all credit to those who ran out and did get petrol. Simon, you made a valid point. You can only fill up a tank. It's only going to last you a week, maybe two at a push, and then you're stuck with the new prices anyway. So you've saved yourself $4 once. I mean, sure, great. If your tank was nearly empty, yeah, wonderful. You've saved yourself $4. But yeah, my point though, if this goes on for a period, we will feel it,
Yeah.
and that's when you start to see the impact.
Yeah, and you're starting to see the politicians talking about this. So the Treasurer is in the news this morning talking about this likely to have a, quote, significant impact on the economy, depending on how long things drag out for. And talking about, again, well, what does that mean for the May budget and all of that? So there's a lot of talk right now about potential impact and how big the impact might be. I think for the Reserve Bank, they're in an awkward position here in that if they're trying to contain inflation with the one tool that they really have, which is interest rates, then if inflation goes up, the idea conceptually is that you put up interest rates to suppress demand to try and drag it back down. The thing that I would argue anyway, and a number of economists would argue, but not all, is that you can't really fix easily a supply side shock like this that might drive up prices for a few months. You can't fix that by suppressing demand, because the fundamental problem is not the demand side, it's the supply side, it's a shortage. And so you run a risk if you go too hard too fast that you really crush the economy. You've got businesses that'll be acting from a perspective of uncertainty at the moment. They won't necessarily be making hiring decisions. They won't necessarily be making investment decisions. If you crush that even further by jacking up interest rates, making it harder for businesses to borrow, then you run a real risk of increased unemployment, suppressing the new economic growth that we're seeing, although, to be fair, that's largely driven by government spending, not the private sector anyway. But if you really crush that by going too hard on interest rates, you end up in a worse position down the track than if you'd potentially just let the inflation work its way through if it was going to be short term anyway. There's a strong argument to say that jacking up interest rates really fast as a knee-jerk reaction to a sudden spike in petrol prices would be the wrong move, because it could set you up for a bigger hurt later than just giving it a little bit of time to see what happens.
I don't think they'll be doing anything, particularly in interest rates. I mean, interest rates is a big sledgehammer and a big impact. And to do anything on that carries a significant and long-term consequence on the country and on the economy. You're right. If it's switched on in an instant and then switched off in an instant, such that flow, let's say it switches on, goes for 6 weeks, and that's switched off, and oil flows again, let's say, then you've had a 6-month decision on impact for interest rates that had a 6-week time frame. Then you've got to adjust it again at a later stage. So there's some real vulnerability there. And you're right, rock and a hard place for the RBA.
Mm.
So my judgment call on that is it is going to be a do nothing for a period of time, because it's suck and see, because it's too early, and the impacts haven't hit us yet. And I think that the RBA is going to be more reactionary rather than precautionary. I don't think it's going to necessarily be proactive on an assumption that things will get worse. I think things will have to get worse before they act. And given they're now meeting every 6 weeks, a 6-week interval between 0.25 rises or from zero to let's do it is not significant. So there'll be enough time for us to recognise that, yep, this is coming and the need exists. As for them, let's talk about if I'm in a deal, if I'm in a project right now, how does this going to affect the profitability of my deal? Well, what do I need to do now to ensure that I can see this through? When something like this occurs, property prices themselves neither go up nor down. It's a suck it and see a hole. I think there'll be a consciousness around, all right, let's not go aggressive in buying a project dependent on growth for our profit. Let's not panic either about property decline and sell immediately. This is a conscious decision around, well, where are we at? What period of time have I got left in the project I'm doing? If it's a reno, it's short. If it's a development, it's long. If you're at the back end of the development, what changes? So there are some vulnerabilities. My encouragement for you is to forecast out in your mind again, you should have some sort of Gantt chart plan around when your project completes. So if you've got 3 months or 6 months or 9 months before it completes, what's the impact to you should prices start to plateau out? Now, in the three major states that you've got significant growth, what's the impact? Are we likely to see a massive halting of growth immediately now, or is it more of the same? My read on that is it's actually likely to be more of the same, but with a plateauing. It's going to cool faster than otherwise might be. There will still be a trend, but it will start to cool. In the flatter
Yeah.
markets, are we going to see a decline? Are we going to see a massive drop? I say no. We're still looking at flatter markets, at least for the immediate term, 3 to 6 months. Now, if this thing goes on, the 6 months looking a little bit shaky. If you're in a high growth market and you're 6 months on, don't expect the same sort of growth should this be going on in time. It's still very new for us and it's something to monitor and watch.
So I think as prudent investors, the answer isn't to panic or throw our hands in the air or act with paralysis because we just don't know what to do. The answer is to look at what you can control. And so if we're doing projects or if we're looking to buy a property, whether it's to hold for growth or to do something for a profit, then we need to consider the possibility that rates do go up and in response to this, and that the possibility that they might go up a little bit faster than they otherwise could have. So you should be looking at your numbers in your deals, in your current deals, and going, well, what if my interest rate was, say, half a percentage point higher than it is now? What if it was a percentage point higher than it is now? What does that do to my bottom line? And what does that imply in terms of my ability to absorb that if I have to? Does it then compromise the viability of the deal? If I was looking to buy something new, then that might be a reason to rethink going into a deal on a particularly skinny margin or on a particularly narrow buffer on interest rates. So you want to just make sure your numbers still stack up. I think the point you made earlier, Brendan, in terms of people's behavior and how the market might respond to this in terms of things like growth, obviously uncertainty and the possibility that rates might go up, or just the fact that people are going to feel this in their back pocket at the Bowser and possibly in the price of other goods and services, means that it's going to be more demand suppressing than demand stimulating, obviously. So we shouldn't be speculating on wild growth moving forwards. We should be tempering our expectations in terms of where the market might be, not necessarily because it will play out that way, but just as a risk management tool in our deals. We just need to think about, okay, so if I'd priced in some anticipated growth into my numbers, maybe I need to just wind that back a little bit and make sure the deal still stacks up. If I'm concerned about where prices might be in 6 or 12 months from now, and I'm doing, say, a development or something like that, maybe I focus more on selling off the plan now if I can secure a good enough price by selling off the plan rather than speculating on where prices might be 12, 18 months down the track.
There's also the point around the concept cash flow is king. Make sure you've got enough buffer right now. Should there be a delay in the supply of something? Should there be a lift in costs of materials? What is it that you need in your bank accounts to ensure that you can continue with the project as it plays out and cash reserves aren't drained because of cost blowouts or expenses that have gone up? So manage your finances so that your buffer may be a little larger than you otherwise anticipated you might need, or be a little more conservative perhaps on your buffer. Be a little conservative on your price growth expectations and price position at the sale or at the completion of your project. And if you monitor that as a be alert, not alarmed type approach, then I think you're well poised and well positioned to drive this through. And if you've got a 0.5% buffer relative to when your project actually ends, some conservative analysis now around profit expectations and timing of sales, etc., or can you shorten the project, exit early? We're suggesting monitor for impact and have exit strategies that suit relative impacts that you're potentially seeing along the way.
Yeah, and I think really important at these sorts of times when you get the sort of noise from the media and genuine issues that are going on out there, it's really important not to fall foul of base emotions like fear or greed. You really want to temper the greed gland times like this. If securing the outcome of your project and making a good enough profit means trimming your margin by a percentage point or two, but you mitigate your risk in terms of timeline exposure, then that could be a prudent thing to do, rather than just hoping and praying that the market takes off or that all this is resolved in 3 to 6 months.
The message here, as I see it, is go back to your numbers, reassess upside risks, downside risks, pick the middle road for the moment, and monitor. That's all we're saying. Yeah, don't be dramatic about it, just be aware of it. And look at the various exit strategies, the ways you can manage the contingencies should they occur. And that's all that we're at right now. Plan for the various different outcomes that you foresee as possible.
Yep.
Sitting there with your head in the sand going, it's not happening, la, 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 is not an answer. Don't be an ostrich here. Just be mindful and aware.
Keep an eye on what the Reserve Bank does actually say in its official releases. So at the next RBA meeting, we want to look at those sort of monthly inflation prints, check how they're trending. Look at what's happening with unemployment as well over the coming months. All of these things will factor into how we would expect things like rates, decisions, and so on to unfold over the coming months. And no doubt you and I, Brendan, will loop back to this on subsequent Fireside Chats as
Absolutely.
well. Question, would it be
wise to get into a fixed price building contract now? One would suggest you're in fixed price building contracts predominantly anyway.
You could look at that question in two ways. There's the question of, well, should I lock in my building price now if I've got the opportunity to, on the basis that prices might go up? So if you're committed to the project and if there's no particular reason to delay or put the project on ice because of your assessment numbers, then, well, build prices could very well go up, and generally do go up over time anyway, but there's every possibility they could go up. So if you can lock in your price now, great. If the question is more about, should I commit myself to the build now? Well, I think that comes back down to the question of the numbers and being confident enough around your numbers, the saleability of your project, and the buffers that you've got built into your feasibility.
Any final words, Simon?
Yeah, just again, a shout out to the new members that have joined us over the last week or so. If you're new to the community, a couple of next steps to focus in on. Make sure you do set up your profile, complete your bio and answer the questions and upload a photo of yourself so that people can see who you are and you can make those valuable connections in the community. Answer that icebreaker question as a way of introducing yourself. And make sure you get into the upcoming event space and RSVP for these Fireside Chats and the other events that are coming up. Check out the replays of recent Fireside Chats and other webinars and the like that we've done in the event replays space, and make the most of the resources that you've now got at your fingertips.
If you've enjoyed today and you're seeing the value in the resources available, share the word, get it out there. If this is stuff that's insightful for you and a benefit for you, make sure all the property investors in this country know about it. If everyone's working better and working together for a better outcome, then we're all going to win. Guys, to Emmett again, invest wisely. See you.
Thanks, everyone. See you next Thursday.